Welcome back to the Deep Dive, your shortcut to being truly well-informed. Today, we're tackling something many of you have asked about, and honestly, for good reason. We're talking about how to confidently begin your investment journey in the stock market, specifically in 2025. If all that finance talk sometimes feels like, a whole other language. Well, this deep dive is meant to be your plain English roadmap. We want to cut through the noise and get you started on the right foot. Our mission today, it's simple. Give you a practical, simple, and updated guide for navigating the market this year. We'll unpack the essentials, really focus on what matters for you as someone new to this, and show you how to build a solid foundation.
Exactly. And 2025 is actually a really interesting time to start. What's changing things isn't just low fees, those help. It's also the tech, like AI-powered robo-advisors becoming much more common.
Oh, right. I've heard about those.
Yeah, these tools can automatically rebalance your portfolio, manage risk, even do sophisticated things like tax loss harvesting, stuff that, used to require a human advisor and a lot more money to access.
So it's more accessible now.
Way more accessible. Even if you're starting with just a few $100s, you can get a level of sophistication that was, frankly, reserved for wealthier folks before. So we're here not just to say what to do, but explain why it actually empowers you now.
That's a great point to start with. Okay, so let's really break down the absolute basics before anyone even thinks about investing a single dollar. What exactly is a stock or a share? People throw those terms around all the time.
Right. Simply put, a stock or a share is just a tiny piece of ownership in a company. When you buy, say, one share of a company, you literally become a part owner. A very, very small part owner, usually, but an owner nonetheless. And if the company does well, makes profits, grows, the value of your piece can go up.
Okay, simple enough. Ownership. And the stock market, then? Is it like Wall Street, that building?
Well, not really a single building anymore. Think of it more like a huge global digital marketplace. It's where all these pieces of company ownership, these stocks, are bought and sold between investors. Major hubs are places like the NSE and BSE in India, or the NYSE and NASDAQ in the US, but it's all interconnected electronically.
Gotcha. Online marketplace.
Exactly. And besides individual stocks, you'll hear about mutual funds and ETFs, exchange-traded funds. These are basically prepackaged baskets of stocks. Professionals manage them, pooling money from lots of investors.
So you don't have to pick every single company you're
Precisely. It gives you instant diversification, which is really important. We'll probably talk more about that later.
Definitely. And what about an index? Like you hear the Nifty 50 is up or the S&P 500 fell. What does that signify?
An index is basically a benchmark. It's a list, a curated basket of top companies chosen to represent the overall health or performance of a specific market or sector. So the Nifty 50 represents the 50 largest companies on India's national stock exchange. The S&P 500 tracks 500 large U.S. companies.
So it's like a snapshot of the market's mood.
Kind of, yeah. A snapshot of how the biggest players are doing on average. And many of those index funds and ETFs we mentioned, they just aim to copy the performance of a specific index. Offers broad exposure easily.
Okay, basics covered. Stocks, market, ETFs, indices. So knowing that, what's the very first thing you, the listener, should actually do? What's step one on this personal journey?
Right. Before anything else, step one is defining your financial goals. And just as importantly, being really honest about your risk tolerance. Are you saving for something relatively soon, like in the next 1 to 3 years? Or is this for the long-haul retirement, maybe buying a house in 10, 20 years?
The timeline matters a lot, huh?
Hugely. And tied to that is risk. How comfortable are you, really, with seeing your investment values drop? Could you stomach a temporary 20% or even 30% dip without hitting the panic button? That self-awareness is absolutely critical.
It leads perfectly into managing expectations. If you are aiming for long-term growth, there's a sort of golden rule about which money to use, right?
Oh, absolutely. The golden rule, if there is one, is only invest money you are reasonably sure you won't need for the next 3 to 5 years, minimum.
3 to 5 years. Why that time frame?
Because markets go up and down in the short term. That's just how they work. Volatility is normal. If you invest money you might need next year for, say, rent or tuition, and the market happens to be down when you need it, you could be forced to sell at a loss. Giving your money that 3 to 5 year buffer, ideally longer, allows time for potential recovery from downturns. It manages your expectations and stops you from panic selling.
Which often locks in losses.
Right, yes. Panic selling turns a temporary paper loss into a very real permanent loss.
Okay, so goal setting, risk assessment, Using the right money. But before we even get to opening an investment account, you mentioned a foundation.
Yeah.
What's this essential financial safety net we need?
Yes, this is non-negotiable for real long-term success. Think of it like building a house. You need a solid foundation first. Number one, an emergency fund. Aim for 6 to 12 months worth of essential living expenses.
6 to 12, that sounds like a lot.
It can be, but it's crucial. Keep it somewhere safe and easily accessible, like a high-yield savings account, not invested in the market. This fund means if you lose your job or have a big medical bill, you don't have to desperately sell your investments when they might be down.
Okay, emergency fund. What else?
Number two, essential insurance. Health insurance is a must. If you have dependents, life insurance is also critical. These protect you from financial disasters that could wipe out savings and investments. And number three, tackle high-interest debt, especially things like credit cards.
Why debt first?
Because the interest rates on credit cards, for example, are often incredibly high, 15%, 20%, sometimes even more. It's almost impossible to reliably earn investment returns higher than that. So paying off that high-interest debt is usually your best guaranteed financial return. Get rid of it first.
So connecting the dots here.
Yeah.
Having that stable home base, the fund, the insurance, low debt, it directly helps your investments succeed.
Absolutely. It provides resilience. It lets your investments actually do their job, which is to grow over the long term, without being derailed by life's inevitable curveballs. Your investments shouldn't be your emergency plan. Building this foundation is how you ensure they're not forced liquidations. It's discipline, and it builds way more wealth over time than jumping in unprepared.
Right. The foundation is built. Emergency fund check, insurance check, nasty debt gone check. Now we're ready. Let's explore the actual investment options. What's in the toolkit for a beginner in 2025? What are the main choices, and how do they stack up risk-wise?
Okay, the fun part, yeah, you've got a range of options. On the higher risk, potentially higher reward end, you have direct stocks, buying shares of individual companies. This is really for people who are willing to do the homework, research companies, understand their business.
Takes more effort then.
Definitely. Which is why for beginners, we often lean towards things like index funds and ETFs. We touched on these low-cost, automatically diversified because they track a whole market index like the S&P 500 or Nifty 50, much simpler starting point.
Okay, what else?
Then you have actively managed mutual funds. Again, professionals pick the stocks, often focused on a specific strategy or sector. You can often invest in these through a SEPI, a systematic investment plan, which is super convenient. We'll talk more about SESPs. Something a bit different is REITs, real estate investment trusts. Lets you invest in big property portfolios like malls or office buildings without buying the property yourself. Kind of like a stock, but for real estate.
Interesting. Like being a landlord without the hassle.
Sort of, yeah. And finally, for the lower risk end of the spectrum, you have bonds and government securities. These are essentially loans you make to companies or governments paying you fixed interest. Generally safer, but usually lower returns than stocks over the long run.
That's a good overview. Lots to choose from. If you had to pick one starting point for a complete beginner this year, 2025, what's your top recommendation?
For most beginners in 2025, I'd strongly suggest starting with index funds or ETFs.
Why those specifically?
They just tick a lot of boxes for someone new. They're low cost, they provide instant, broad diversification across many companies, which lowers your risk significantly compared to picking just one or two stocks. You get exposure to the overall market's growth without needing deep company knowledge right away. Then, as you learn more, maybe get more interested, you could gradually add a small amount of direct stocks if you want, maybe that 20% we might discuss later.
Okay, so start broad and safe, then maybe specialize a bit later.
Exactly. It's a balanced approach. Participate safely, learn as you go. It makes the whole journey less intimidating and more sustainable.
All right, we know what we might want to invest in. Maybe start with those index ETFs. Now, the practical part, how do you actually buy them? You need accounts, right? What are these DMAT and trading accounts?
Yes, you need the right accounts. Think of the DMAT account like a digital vault or locker. It's where your shares and ETFs are held electronically in your name, safe and sound. The trading account is your interface with the stock market. It's the account you use to actually place the buy and sell orders.
Do you need to open them separately?
Usually, no. When you sign up with a brokerage firm, you typically open both together as a package. It's streamlined, and choosing a broker is your next step. In India, you have very popular user-friendly options like Zerodha, Grow, Upstocks, Angel One, tons of good choices. In the US, you're looking at established names like Robinhood, Fidelity, Charles Schwab, Vanguard.
And is opening these accounts complicated? Lots of paperwork.
It used to be maybe years ago, but honestly, now. It's remarkably simple, mostly online. You choose your broker, then you do the KYC process, that's know your customer.
Right, the identity verification stuff.
Exactly.
Yeah.
You'll need to provide standard ID documents like your PAN card, a Aadhaar, and bank details in India, or similar equivalents like SSN and bank info in the US. Upload the documents, maybe do a quick online verification. Once approved, you link your bank account, transfer some funds in.
And you're ready to invest.
Pretty much. You can then place your first buy order through the broker's app or website. The whole digital onboarding process has made it incredibly easy and accessible for almost anyone.
Okay, account's open, money's in, now we're actually investing. A key piece of advice you always hear is start small and diversify. Let's break that down. What does diversification really mean in practice for a beginner?
Diversification is probably the single most important risk management tool. At its heart, it means not putting all your eggs in one basket.
So don't dump everything into one company's stock.
Please don't. That's incredibly risky. If that one company hits trouble, your entire investment could suffer badly. Instead, you spread your money across different investments. This could mean different companies, different industries or sectors like tech, healthcare, banking, consumer goods, maybe even different countries, like adding some US or global exposure alongside your home market.
Okay, spread it out. Is there a rule of thumb for how to do that starting out?
A useful guideline, especially for beginners, is sometimes called the 80-20 rule. Put maybe 80% of your investment money into those safer, broadly diversified options we talked about, like index funds, ETFs, maybe some stable mutual funds. Then the remaining 20%. You could allocate that to direct stocks if you're interested in learning to pick individual companies.
So the 20% is like your learning and potential high growth zone.
Exactly. It lets you experiment, learn about analysis, maybe chase some higher growth, but without risking the bulk of your capital. If one of your stock picks doesn't work out, it doesn't sink your whole portfolio because 80% is still anchored in diversified funds. It's a smart way to manage risk while learning.
That makes a lot of sense. Okay, managing risk through diversification. Now, what about actually analyzing investments, especially for that 20% in direct stocks, or even choosing between funds? How do we start figuring out what's a good investment?
Great question. For long-term investing, the main approach you'll want to focus on is called fundamental analysis.
Fundamental. Okay, what's that?
Think of yourself as a detective investigating the company itself, not just its stock price's wiggles on a chart. You're digging into the company's underlying health and value. You ask questions like, is its revenue growing? Is it actually making a profit consistently? How much debt does it have? Is it manageable? Who's running the company? Do they have a good track record? And importantly, does the company have some kind of competitive advantage, something that protects it from rivals?
So, looking at the business itself, are there specific numbers or metrics people use for this?
Yes, definitely. You'll come across various ratios and metrics. Don't let them intimidate you. They're just tools. For example, the PE ratio, price to earnings, gives you an idea of how expensive the stock is relative to its profits. A lower PE might suggest better value but needs context. ROE, return on equity, shows how well the company uses investors' money to generate profit. Higher is generally better. EPS, earnings per share, tells you the profit allocated to each share of stock. You typically want to see this growing over time. Debt-to-equity ratio shows how much debt the company uses compared to its own funds. Too high can be risky.
Okay, so these numbers help paint a picture of the company's health and value.
Exactly. They're clues in your detective work. You use them, along with qualitative factors like management quality, to decide if a company is a solid, long-term investment.
Right. And I've also heard about technical analysis, charts, patterns. What's that about, and should beginners worry about it?
Technical analysis, that's quite different. It ignores the company's fundamentals, mostly, and focuses purely on past stock price movements and trading volumes. Technical analysts look at charts, identify patterns, use indicators like moving averages or RSI, trying to predict short-term price direction.
So it's more about predicting the price swings.
Essentially, yes. It's often used for shorter-term trading rather than long-term investing, and honestly for beginners. My strong advice is to focus almost entirely on fundamental analysis and long-term investing.
Why not technicals?
Technical analysis can be complex, it requires a different skill set, and it's often associated with more frequent trading, which can mean higher costs and potentially more emotional decisions. Plus, trying to predict short-term market moves is notoriously difficult, even for professionals. For building long-term wealth, understanding the business you own fundamentally is usually a much more reliable path.
Okay, focus on fundamentals, think long-term. Got it. So once you've done some analysis or chosen your funds, What are some proven strategies for actually putting the money to work consistently?
Yeah, there are some really effective time-tested strategies. One of the most popular, especially with mutual funds and ETFs, is the SIP Systematic Investment Plan.
How does that work?
It's beautifully simple. You commit to investing a fixed amount of money automatically every month or maybe every quarter. Say $5,000 or $100 every month goes into your chosen fund. It makes investing regular and disciplined, takes the emotion out of deciding when to invest.
And that leads to dollar cost averaging, right?
Exactly. SIP naturally implements dollar cost averaging. Because you're investing the same fixed amount each time, you automatically buy more units or shares when the price is low and fewer units when the price is high. Over time, this averages out your purchase price, potentially lowering your average cost per share compared to trying to time the market highs and lows, which is nearly impossible to do consistently.
So it smooths out the ride a bit.
It does. And then there's the overarching philosophy for many long-term investors: buy and hold. This means you select good quality investments, whether funds or individual stocks, based on fundamental analysis, and then you simply hold on to them for the long term. We're talking 5, 10, 20 years or more.
Resisting the urge to constantly buy and sell.
Precisely. You ride out the market ups and downs, trusting that good investments will grow over time. It embodies the famous saying, time in the market beats timing the market. Patience and compounding are your best friends here.
Okay, let's make this really concrete. Can you give us an example of what a beginner's portfolio might look like in 2025 using these strategies? Say someone decides to invest $10,000 per month via SIP. How could they split that up?
Sure. A simple diversified example for $10,000 a month could be maybe $5,000 goes into a Nifty 50 index fund or ETF. That gives broad exposure to the top Indian companies.
Okay, half in the home market index.
Right. Then for international diversification, maybe 2,500 into a U.S. index fund like an S&P 500 ETF spreads your risk geographically.
Makes sense, global exposure.
Then perhaps 1,500 into a good quality diversified blue chip mutual fund. These typically invest in large, stable, well-established companies, could offer slightly different exposure than the pure index.
Okay, Nifty, S&P 500 blue chip fund.
Yeah.
LAD's 1,000.
And that remaining 1,000, that could be your allocation for direct stocks, using the 80-20 idea. Use that small amount to start researching, maybe buy shares in one or two companies you've studied carefully. It's your learning fund.
So diversified core plus a little bit for active learning.
Exactly. And the key thing to remember is the power of compounding. Investing 10,000 euros consistently every month like this, even with average market returns, can grow into a very significant amount over 10, 15, 20 years. It's truly how wealth is built steadily over time.
That's a great practical example. Now, the flip side, we need to talk about the mistakes. This feels really important, maybe where a lot of good intentions go wrong.
Yeah.
What are the common pitfalls you, the listener, absolutely need to sidestep?
Oh, this is crucial. And so much of it boils down to psychology and discipline. First, a big one: investing without having those clear goals we talked about earlier. If you don't know why you're investing, it's hard to stick with a plan.
Right, drifting aimlessly.
Second, following tips blindly, especially from, random sources on social media, friends who claim they have a hot stock. It rarely ends well. Do your own basic checks, at least.
Yeah, the get-rich-quick schemes rarely work.
Third, we mentioned it, but it's worth repeating: putting all your money in one single stock. Diversification is your friend. Fourth, and this is a huge one, panic selling during market dips. Markets correct, they go down sometimes. Selling in a panic just locks in your losses. You need the resilience to ride it out if your long-term view hasn't changed.
Easier said than done sometimes.
It really is. And finally, related to that, expecting to get rich overnight. The stock market is a powerful wealth-building tool, but it works over years and decades, not days or weeks. It's a marathon, not a sprint.
That panic selling point, it really highlights the mental side. How can people actually build that mental strength, that resilience, to avoid those emotional traps like fear and greed?
Building that mental fortitude is key. Part of it comes from education, understanding that volatility and market downturns are normal, expected parts of investing. They happen. They've always happened. Knowing your history helps, but also having that clear long-term plan and sticking to it. If your goals are 10 years away, does a bad week or month really change anything fundamentally? Probably not.
So perspective helps.
Perspective is huge. And diversification helps too, psychologically. Knowing you aren't overly exposed to any single company's failure makes it easier to stay calm. It's about training yourself to react rationally based on your plan, not emotionally based on the day's headlines or market noise. Turn off the constant updates if you need to.
Good advice. So alongside investing itself, it sounds like there's a parallel track of just Continuous learning. Staying informed seems pretty vital.
Absolutely essential. You don't need to become a Wall Street expert, but staying generally informed is smart. Make it a habit to read reputable financial news sources, maybe Money Control, Economic Times in India, Bloomberg, Yahoo Finance globally. Get a feel for what's happening.
Keep up with trends, too.
Yeah, be aware of major market trends. Like right now in 2025, areas like artificial intelligence, green energy, electric vehicles, digital payments, these are sectors seeing a lot of change and investment. Doesn't mean you pile in blindly, but be aware. And, read some of the classic investing books. The Intelligent Investor by Benjamin Graham is basically the Bible of value investing. One Up on Wall Street by Peter Lynch has fantastic practical advice.
So learning protects you.
Learning empowers you. It helps you understand the why behind your strategy, filter out the noise, ask better questions, and make decisions based on knowledge and logic, not just fear or hype. Critical thinking is your best defense.
Okay, so putting it all together, strategies, avoiding pitfalls, continuous learning. It really feels like success boils down to a core mindset. If you had to summarize the essential mindset for long-term investing success, what would it be?
You've nailed it. The mindset is arguably the single most important factor, more than picking the perfect stock. Number one, be patient. Wealth creation takes time, years, decades. Compounding needs time to work its magic. There are no shortcuts.
Patience. Got it. Number two, be disciplined. Stick to your plan. Invest regularly, like with an SIP, even when it feels boring or scary. Consistency is key.
Discipline. Makes sense.
Number three, be rational. Try as much as possible to remove emotion from your decisions. Fear and greed are terrible investment advisors. Make decisions based on your goals and your research, not on market frenzy.
Stay logical.
And finally, number four, think long-term. Always focus on your ultimate financial goals, building wealth for retirement, for your family's future. See the stock market as a tool for that long journey, not as a casino for quick bets. Strategies, tools, analyses, they all support this mindset. But without patience, discipline, rationality, and a long-term view, even the best tools won't get you there. Fantastic summary. So there you have it, everyone. A pretty comprehensive but hopefully straightforward guide to starting your investment journey in 2025. Let's quickly recap the core message. Learn the basics first. Define your goals and risk tolerance. Build that solid financial foundation, emergency fund, insurance, no high-interest debt. Open your DMAT and trading accounts. Start small, probably with diversified options like index ETFs or mutual funds using that 80-20 idea. Gradually learn about direct stocks if you want. Stay consistent, invest regularly, and crucially, avoid those common emotional mistakes.
And maybe to leave you with something to think about, given how much easier and more accessible investing has truly become in 2025, with the tools and low costs available, and knowing the proven, almost undeniable power of long-term thinking and compounding, what's the one single action, however small, that you could take today to start applying this knowledge and actually begin building your financial future?
That is a powerful question to mull over. A huge thank you for breaking all that down for us. And thank you for joining us on this deep dive. We really hope this has given you the confidence and clarity to take that important first step. We'll catch you next time.